Hey folks, welcome back and thank you for joining us. Welcome to Master Plan Retirement's Retirement Roadmap. My name is Evan and with me as always is retirement planner Mark Fricks. Question: how do I reduce my taxes in retirement when I am taking income from my IRAs? Every withdrawal adds to my tax burden. I love this question.
It's a long question with a lot of answers.
Yeah,
right?
absolutely. I mean, and something that's not often considered. First of all, income is generally the primary concern in retirement. Where's that next paycheck coming from? But so often we don't realize, or at least people who we are introduced to in the beginning conversations don't realize that income planning and tax planning go hand in hand with each other.
They really do, and we've for so many years have saved almost all of our money for retirement in those pre-tax accounts, the 401ks, the IRAs, mostly because that's what was offered in the 401ks for so many years. That Roth option, even though it was talked about, it was not easy to do a Roth. I mean, we have so many people that come in, they have a huge 401k of maybe $500,000, and they have a Roth worth $14,000.
Yeah.
Which means they maybe put money in twice, right, and just kind of forgot about it, or things came up. So without that automatic, contribution every paycheck,
set and forget.
It's much more difficult. So what I'm getting to is we've created this big monster of pre-tax money that's going to be totally taxable as it comes out. So that's what we're going to be talking about today. Is what kind of problems does that cause? Are there solutions, things of that nature?
Yeah, and so I want to start out talking about the easy things to avoid. There's a lot of things that are built in, penalties, things like that with IRAs and qualified plans that we need to know first before we can even start moving into a tax strategy. And first of all is you got to know the early withdrawal penalties.
You would think that would be simple, but people miss it a lot. So actually, as you know, 59 and a half, in most cases, you take money out of a Roth or an IRA, either one, you have a 10% penalty on top of your tax that you already owe.
Right.
You probably owe state taxes on that as well. So you have to avoid the simple mistakes first.
Yeah, and there are some options. You could maybe bring out money early if it's a first-time home purchase or certain health qualifications, things like that.
College cost, I think.
College cost as well, I think. So there is potential for avoidance, but any other reason, you're going to get on top of your tax of that withdrawal, that 10% penalty, which is several brackets for most people. If you think about it in a bracket sense.
But I know, I see people do that sometimes, and they do it, maybe they even know there is a penalty, but they panic. They need an infusion of money for whatever reason. And so don't forget, most 401ks will allow you to borrow against them, and there is no penalty to do that, and it's a relatively low interest rate. So think about things like that first before you start digging into that IRA, spending more money and pushing your retirement further down the road as well.
Right. And it's a little bit different for 401k withdrawals. So at 55, if you've left that job associated with that specific 401k, you actually can take withdrawals early as 55.
Same with the thrift savings plan, things like that. And so you have to be careful if you're working with an advisor that either doesn't care or is not a fiduciary or just won't solve your money. As you know, we try to leave some money in that employee plan if they've left, to give them some cash flow or some available backup money, because again, they can get to it without a penalty.
Right.
So just common mistakes that even advisors can make, you've got to keep a lookout for.
And I do want to also make the distinction between withdrawals and rollovers, just so that we're on the same page. Withdrawals is literally just removing that cash, paying the tax on it. It's no longer in a qualified account, IRA, 401k, anything like that. A rollover, for instance, is moving funds from that 401k or employer-sponsored plan to an IRA, and that's a non-taxable event.
Yeah, we use that all the time, of course, because 401ks are good savings vehicles for long time periods, but they're not great retirement vehicles. Right. And so that's when we start moving, and we've talked about this in other shows as well, getting some of that money out of that one big growth bucket into various IRAs that can function with different jobs. The job of this IRA may be to provide early income. This was later income. This one's early growth. This one's later growth, tax-free. tax-free conversions. And so that one big 401k may become 10 accounts, each with a job, and it just becomes much more efficient. Be careful if you're working with somebody that's not familiar with retirement, as opposed to just an advisor that likes to invest money. It's a totally different realm of expertise, and you need to find somebody that's done it before. That's all we do primarily, is work with people getting ready to retire, wanting to retire, or in retirement. And so that is something that we do every day. So be careful who you're working with when it comes to those.
Yeah, and so generally for most people, again, we mentioned age 55 for old 401ks, things like that, of being able to withdraw a little earlier. But for most people, 59 and a half is going to be the age where you're able to actually start moving money to other retirement accounts and setting yourself up and really starting to enact and set your plan up for retirement.
Right, and that's a powerful tool as well, even if you're still working. It's called an in-service age-based rollover. So if you're 59 and a half or older and you're working for a company and you have a retirement account there, you can go ahead and roll that over into, again, personal individual IRAs. And why would you want to do that? Well, again, get a step ahead of retirement. Go ahead and let these accounts begin seasoning. Go ahead and get a higher level of management. I mean, your 401k is probably not being managed very much. You have limited choices. I mean, I've seen, well, like the thrift savings plan has 5 funds in it. 401ks, I've seen them have 20. I've seen them have 500. But still, you've got the world in an IRA. You can do physical precious metals, gold and silver in an IRA. You could do rental houses in an IRA. There's so much more you can do when you get that into your own account, and with the help of a good fiduciary advisor, make the right choices as to what each bucket's doing for you.
And you made a really good point that also we find more people than not don't realize at 59 and a half, you don't have to end your job to move money out of your 401k. You can move a portion out and continue contributing to that 401k with your monthly paychecks and go ahead and get some money working for you elsewhere.
That's important to note. It does not close your 401k. Right. So say I'm working for Lockheed, I've got a 401k there. They allow me to roll over 80% into individual IRAs. My very next paycheck, some of it keeps going in there. Lockheed keeps matching it. It keeps going on, and we may roll over 4 or 5 times between the ages of 59 and a half and say 65 when they finally do retire, just to make sure that money is continually being better managed and better positioned for retirement.
Absolutely. Something else to think about a little bit further down the road from 59 and a half, but there's something called RMDs, or required minimum distributions.
So multiple choice. What age do you take your RMD? 70 and a half, 72, or 73? Call in with your answers right now. 5th caller wins.
Or 75.
That's true. So the laws have changed like 3 times in the last few years. Secure Act 1 raised it from 70 and a half to 72. You are required to take a percentage out of your IRAs every year, and that percentage grows every year, so it's a bigger check every year. Secure Act 2 changed it to age 73. Unless you were born in 1960 or later, then it's 75. So again, I know it's hard for us to keep up with. I don't know how people keep up with it on their own, for sure. But that causes a lot of issues, which we're going to, I think, dig into a little bit.
Yeah, sure. Well, there's a penalty for missing the RMD. It used to be half, 50% of the total that should have been resigned.
On top of your tax.
On top of the tax. But now, fortunately, the IRS has helped us out a little bit. It's only 25% of what you were supposed to pull out. If you try to catch up, you realize you missed it or something, and you show the IRS that I'm actually trying to get this out now, it was a mistake, there is a possibility of them lowering the penalty to 10%, maybe even 0, I don't know.
Yeah, it depends how quickly you jump on it and things like that. Yeah, we've had one client that we manage our clients' RMDs, as you know, required minimum distributions. I had one client that decided they would do it on their own. They didn't do it soon enough. It did not come into the following year, but I think we were able to, do the letter and things like that. And I don't think he paid any kind of a penalty.
Okay,
but
great.
Again, you got to jump on it pretty quick.
Yeah, and again, just as Mark said, keep in mind, even if you do pull out your RMD when you're supposed to and there is no penalty, you are taxed at your tax rate that year. And it also adds to your tax rate that year. Whatever you pull out is increasing your income for that year.
So the question we ask when we teach our tax class is, what bracket are you going to be in 10 years? Of course you don't know, right? We don't know because, number one, we don't know how much money we'll have coming in from various sources. We think we know, we may not know. But number two is, we don't know what the brackets will be overall in 10 years. Again, 35.9 trillion in debt, and that's rolling every few seconds is adding another $100,000 to that. Medicare is in trouble, Social Security is in trouble. A lot of people in Washington wanting to spend your money, and so there's going to have to be a day of reckoning to where those taxes are going to have to dig deeper and deeper. And, you know, we've seen studies, they can raise the taxes on all the billionaires and most of the millionaires. It still is not enough. It's going to be the middle class that's going to have to tackle the majority of that. So, again, what's your tax bracket going to be in 10 years? Wish I could tell you, but let's get to work now so that we can get some of that IRA money to where maybe it's tax-free in retirement.
That's right. And if you want to discuss your own retirement, tax strategy, income strategy, the entire holistic retirement plan, please visit our website, masterplanretire.com. You can go directly to our calendar and find a time that works best for you. It's an opportunity to discuss your retirement, your hopes, your dreams, your fears, have a series of reports ran for you, and have your own 10,000-foot view outlook of your own retirement.
Yeah, the website's a great place to go because of the fact that there's a little button on there. Besides all the resources that are there, there's a little button that says schedule an appointment, and that complimentary consultation gives us a chance to chat with you, kind of discover what your dreams, your goals are, also what your concerns are, your worries in retirement. We all have them, okay? And so we want to get a vision of that and run some reports for you. This is, again, complimentary to see if those worries are justified, to see if you have enough money to last a lifetime and what could cause you to trip up. So masterplanretire.com or phone number, right? We still use phones, 770-980-9262. And again, we'll be glad to get something on the calendar for you.
So we were just discussing RMDs. Now there's one other thing I'd like to mention, and that is qualified charitable distributions. So if you take your RMD and that you send that directly to a charity, it's actually not taxed. And at least, gosh, how much?
Up to 200,000 a couple.
200 per couple, so 100,000 per person.
Right.
You can do that on.
Which, if that's your RMD, congratulations.
Yeah.
That means you have about a $5 million IRA.
Right, right.
So,
but
yeah,
this question actually specifies that they're taking income from their IRAs for retirement. So I'm assuming they don't have that much to give away to charity. Now, there are strategies to work that out to where you can balance that. But for now, I'm going to assume that QCDs aren't part of this conversation.
Right.
They need the income from their IRAs for their monthly in retirement.
Which a lot of people will.
Which most people will,
yeah,
absolutely.
With pensions going away and Social Security not keeping up with inflation. That's why we saved that money all those years, is that income. And again, hopefully you've saved some money in a post-tax Roth type investment. And if not, and even if you have, part of what we do as our tax strategies is look at conversion opportunities to get some of that IRA money into some Roth situations, which will never be taxed again.
Exactly. So earmarking a portion of your retirement to an after-tax Roth account could supply some tax-free growth and tax-free withdrawals in your retirement.
Well, I think a lot of people still don't realize that most of your 401ks now have a Roth option.
Yeah.
And so that's been around now for 5, 6, 7 years. More and more companies are adopting it. We know the Thrift Savings Plan with the federal government now has a Roth option. And still, chat with us or whatever, but be careful, because if you start suddenly putting your whole contribution into the Roth portion, your paycheck's going to go down because you've lost some of your tax deductions. So we like people to kind of do it incrementally, and let's see what this, okay, if we shift 2% that way, what does your paycheck look like? Well, that's only $25 difference, so I'll do a little bit more and kind of work our way up.
Yeah, there are some very general rules of thumb that are not wrong, but it's taking a lot of assumptions. And one is that if you might end up in a higher tax bracket in retirement, a Roth may help maintain current lower rates. Well, that's of course true. But if you put money into a Roth, you're expecting to be in a higher tax bracket in retirement. And I say yes, in general. If you know you're going to be at a low tax bracket, 10%, maybe you don't need as much tax-free money, but still there's something to that, and we'll get into that, how that affects other sources of income as well. However, there's so much uncertainty built into policy right now, everything else, and we are historically at a lower point of our tax rates as a country. I don't know, just as you mentioned earlier, how much debt our country holds, how much lower our tax rates really can go from here and us to be sustainable.
Yeah, and I know there's talks now of tariffs using that, and a lot of people don't realize before 1913, when the federal tax system came into being, our whole tax system was tariffs. And so, and we had plenty of money coming in. Now it's a different world. I understand that. You've got other issues to think about when it comes to the fact that, you want to keep peace with these countries. But also, the positives are, number one, I think it could drive tax rates even lower. So am I willing to pay 10% more for this television if I'm not paying any income tax or less tax? That's a positive. But also maybe it would drive more jobs back into the U.S. So instead of it being made in China with a 50% tariff, let's make it here in the U.S. and I think we can make it less.
Yeah.
Make it for less than that. So
absolutely.
there's a lot of, you can't just look at one side of the coin. You've got to look at both sides of that, or all 12 sides of that, I guess I should say, of the Rubik's Cube. It's just not a black and white answer. But, when you said a minute ago, you said, well, I think I'm going to be in a lower tax bracket.
How
would you even know?
Well, and then you have to also consider the average retirement timeline. The big early retirement, everyone's traveling, seeing family, all this other stuff. There's a lot that you're trying to do.
You're spending a lot more.
You're spending more. So you might be making more withdrawals on those IRAs. There might be some years where you slow down a little bit more local, but then what do we know kicks in later in retirement? Health, medical bills, long-term care, that stuff can skyrocket. And if, like this question, if you're taking the majority of your income from an IRA, all of that's going to be taxed when it comes out. And we know where costs are in the medical field right now. Medical costs, long-term care is out of control. That's going to add up quickly.
And that's not going away. That's not going away.
And that's not a lower tax bracket.
And we're not even necessarily talking about just long-term care. I'm just talking about deductibles and the cost of Part B. And then we get into a whole nother subject area, right? IRMA, which basically is the fact that the more money you make, then the higher your Medicare Part B premiums are. And I'll just give you a quick idea here. Your base cost for your Medicare Part B is like $175 this year. It goes up a little bit almost every year. Part D is, I don't know, $20, something like that. D is drugs, okay? But another $72 if you get just in the next bracket, which is $212,000 for a married couple. You say, well, that's a lot of money. Yeah, but you take money out of an IRA, it counts toward it. You do a Roth conversion, it counts toward it. And so you got somebody that walks up and says, I just want to convert $200,000. Okay, understand, for the next 2 years, you could be paying $400 in Medicare Part B premiums per spouse, right? If it's a couple. And so there's more to it than just looking at a tax bracket. And so I guess just a warning.
Well, that's great. That's age 65 for Medicare. So
before age 65.
Your Social Security is also affected by your income annually. So you really need to strategize this before you start taking Social Security and make sure if a conversion strategy is right for you from IRA to Roths, this is something you need to have in place and start chipping away at before you start Social Security.
And really the perfect time is if you're between age 59 and a half and 65, you've got a 5.5 year window to really get aggressive on Roth conversions, especially today, as you said earlier, where tax rates are on sale at some of the lowest rates in years. And we think they'll be extended another, hopefully at least 4 years, depending on if newly elected President Trump can extend those tax cuts. And that's one of his top priorities, is to do that. So we've got a 5-year window, especially again, if you're between those ages. And even under 59 and a half, if you've got money in an IRA, now we can't do this from a 401k, but you can convert from an IRA under 59 and a half. So if I'm 55 years old and I've got an old 401k at an old company, get that thing rolled to an IRA and then start doing some conversions and be aggressive with it. It's just it's so many factors that come into play. I don't know how people figure this out on their own. I mean, we spend hours a week working with clients just on the tax portion of their planning.
Yeah, and be as aggressive as you need to be. That's why you need a strategy. Not everyone needs to be in a 0% tax bracket, and that's not necessary for everybody.
Wouldn't mind it?
Wouldn't mind it. We actually do have a couple of clients who are being extra aggressive to do that. They're using Roths, they're using certain insurance products, they're using these sorts of things so that in retirement, the only income that they are claiming is Social Security.
That's right. And that's a beautiful, as we've talked about before, we should get paid But The Power of Zero, the book, the author's name is?
David McKnight.
David McKnight. I can never remember his name. I'm sorry, David. Great book. Power of Zero does talk about how you can actually be in a zero tax bracket. We follow some of those concepts. That's why we do promote the book a little bit. But I still don't think you can read a book and understand how to do it to the optimum efficient effect, I guess is a good way to put that. So again, part of what we do is tax planning on top of everything else, income planning, Social Security planning, and it all comes together into one strategy, all these different moving pieces.
Yeah, and it's not like, okay, one move is going to solve your tax problem. It's a lot of incremental steps and also different approaches. Another concept, an idea that could apply to some would be consider spending down your IRA money a little bit before you take Social Security. Let that Social Security wait and build up a little bit longer, as long as you can wait, and anything that you need as far as drawing income, take that while taxes we know are still down.
As you know, we do that a lot with our clients. We like waiting till 70. In most cases, it depends. Everybody's different. Everybody's health is different. Everybody's needs are different. But like you said, while taxes are low, go ahead and start using some of that IRA money up for income and delay that Social Security, which is less taxable. In every case, at least a little bit less taxable. For some folks, it's 85% taxable. Other folks, 50% taxable. That's half the cost of that IRA money. Use the IRA money now, delay that Social Security. Also get a bigger Social Security check for the rest of your life.
Right. It takes about 10 years to break even on the Social Security amount?
Yeah, well, if you wait from 62 to 70, the break even's right around age 80, give or take. And of course, if you're a couple, we sometimes will have one turn on maybe a little bit sooner, one a little bit later. There's that's a whole show, right? Yeah. But again, it's another part of that puzzle that's not just a flat puzzle. It's like a 3D puzzle. And you got, however many sides to it. How many sides are on a cube? We'll get back to you on that.
6, right?
8? 6? What?
6.
Our producer just shouted out on that. So the whole studio audience is
actually
shouting out.
She shouted out 6, you dummy. But Roths also, that's not the only option for tax-free accounts. I did mention certain life insurance products that we'll use for certain needs that fill certain roles. We use every account as a tool with a specific job. There's also a possibility of putting some tax-preferred investments outside of retirement accounts, not only the IULs, which is the insurance product I'm referring to, but certain accounts that are taxed based on capital gains.
Right, and also accounts, sometimes we'll put non-qualified money into an annuity, not only for the guaranteed income, but it tax defers it. You're not paying taxes on the growth. So there's lots of tools to use. Municipal bond portfolios are fairly effective. They're not tax-free. They're tax efficient. But again, there are tools out there, and we like to use most of them with most clients. I mean, they have multiple tools that we're looking at, again, just to keep an eye on that tax burden, not today, but in the next 30 years.
Well, and just like with overall retirement planning, there's a balancing act, to every strategy, and that's especially true with Roth conversions. How much are we able to convert or build up in tax-free accounts prior to retirement? What's our window for conversion? How long are we going to do that? When is our point where we can no longer really do that and maintain, with IRMA in mind and with Social Security taking that? So there's so much strategy built in that you really have to have a plan.
Well, and the final little point about all of that too is a lot of these strategies we use means less taxes on the next generation.
Yes.
And so your kids or grandkids that are inheriting this money, if they've got to take it out of an IRA, they're paying taxes on it over a 10-year period. If it's a Roth, they still have to take it out, but they're not paying taxes on it. Same thing with an IUL, Index Universal Life. The death benefit is tax-free. So other things to consider that kind of work together, again, even over the next generation or 2 or 3.
Right.
So I think it's been a great show.
Yeah.
We've gotten a lot covered, a lot of ground, very important stuff to consider when planning for retirement. Got to consider taxes. So until we see each other next time, remember always, plan well and prosper. Take care.
This was Retirement Roadmap Radio with Mark Fricks of Master Plan Retirement Consultants. To schedule a complimentary consultation, go to masterplanretire.com or call 770-980-9262. Thanks for listening, and remember, Plan well and prosper.
All matters discussed during this show are for informational purposes only. Each individual situation may vary, and the opinions expressed here may not apply to everyone. Materials presented are believed to be from reliable sources, and no representations can be made as to its accuracy. All ideas and information should be discussed in detail with one of our qualified representatives prior to implementation. Advisory services offered through Master Plan Retirement Consultants, a registered investment advisor in the state of Georgia. Mark Fricks and Master Plan Retirement Consultants are not affiliated with or endorsed by the Social Security Administration or any other government agency.